This week on Phil's Tax Hacks and Other Retirement Facts, let's talk about the market, do a little update, talk about DeepSeek, tech, and all the stuff that's going on out there. So let's dive in and get it rolling. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into the podcast. Thanks for hanging out with Phil and I as we talk investing, finance, and retirement. And Phil, lots of stuff as we anticipated, fast and furious in the new year. So, we might as well not even waste any time. Let's just get into this week's conversation because tech is starting to get a little shaky. Starting to get you said cracks in the wall.
Cracks in the wall. It's starting to get a little shaky here. So we'll see where it goes. So
yeah, for sure. So we got some slides we'll share this week, but I'll let you kind of lead us off and where you want to go and kind of kick things off. But obviously,
sure.
Between the things that President Trump is doing, has got the market kind of shaking a little bit. And then, of course, you got the tech. But I think really the tech stuff seems to be really what's shaking it more than anything else, right?
I mean, tariffs definitely have played into it, some volatility.
Although they didn't last very long because within one day on each thing at the time we're taping this, everybody caved. So, but let's talk about the tech side because I think that's driving things a little bit more. The news is going to spin everything the way they want to spin it, but tech is obviously pretty overweighted. So let's talk about it.
Yeah, and I mean, this is nothing new, right? I mean, we've talked about this over many shows throughout the year of the whole Mag 7, the tech overweighting of the S&P. Bottom line, it's 34% of the S&P, which is roughly what the Mag 7 represents of the S&P. So the other 493 stocks in the S&P are the other 2/3.
Right.
In this case, 66%. So yeah, clearly overweighted to tech. And there's an interesting slide that kind of goes through this multi-year performance just to give it some better perspective of from 2015 through the end of 24, looking at like small cap shares, the Russell 2000 was up 96%. Your Dow was up 161. Just the cap weighted S&P itself was up over 200. Interesting thing though, the equal weighted S&P. So take all the 500 companies and give them an equal weight. It was only up 133.
Okay.
That's a discussion I've had with clients. Nothing new. I mean, if you're a client kind of listening into this, right, that you got to understand where this is coming from. But as you really start to dig into it, so the NASDAQ during that time was up 323%, heavily tech weighted.
Wow, yeah.
Let's just boil it right down to technology. You get into the technology select sector spider ETF. During that time frame was up 481%.
Gee, wow.
So is there a doubt of what drove the NASDAQ, the cap weighted S&P? No, I mean, it's technology clearly has driven it, which is a good thing. But like all things, I mean, they do have their time. And one thing that happened in the news towards the end of January was this introduction of DeepSeek. So kind of our first challenge to AI from the U.S. standpoint.
This is a Chinese-based company, right?
Yeah, so China has released their own version of ChatGPT, from my understanding of it.
Okay.
And the tech side of the market did not react well. So during that week alone, the tech sector ETF was down over 4%.
Yeah.
So there's now clearly some concern of, hey, wait a minute, we don't have a corner on this market. There could be some challenges. In DeepSeek, if you dig into it a little bit, and I've just done some research in it, I mean, they're claiming they can do everything ChatGPT can do, but doesn't have all the technology demand. So like what's driving Nvidia is what's running AI is heavy tech. I mean, there's these chips that they have to be super powered chips.
Yeah, a lot of energy goes into running AI.
Right, to drive all this AI technology. Well, DeepSeek is claiming that they can get the same results and you don't need that.
Wow.
So, I mean, that's going to start, if that is true, and who knows, I mean, this is all just at the beginning. If that is true, I mean, that can change the whole picture.
Yeah.
Well,
and propaganda between, let's say propaganda between company or countries, I should say, and companies is never, so they could be saying one thing and it's totally different because they're not going to obviously let us know what that exactly is, especially state controlled media. Right. So.
Right. Yeah. So you got to take what you're hearing from them with a grain of salt. But I mean, I follow a lot of content creators on AI.
Yeah.
Who've dug into DeepSeek and they're claiming that
appears to be the case. Okay,
reality out there with what it can do. So it's a concern. So the market's starting to recognize that.
Gotcha. Okay.
And so why is it a concern kind of at a bigger level is if you dig into the companies and understand, pricing of markets and that. So we always talk about this concept of price to earning ratio, right? So what is the current price of that stock versus the company's earnings? Well, on average, the non-tech heavy sectors, they're about 20 times their earnings is what the price is.
20 times their earnings.
20 times their earnings, which is high.
It's
so that's
high,
not
yeah.
It's been 17 is kind of the average, somewhere in that range.
Okay.
So we're already broad market on a high side.
Okay, so a little overweighted, but not massive. 17 is normal.
I mean,
okay.
it's been a growth market.
Okay, all right.
But now if we dive into the tech sector, so look at those tech ETFs, they're 26. So it went from 20 to 26. So, I mean, clearly the tech is the pricing is significantly higher as a percentage of their earnings versus the general market, which, I mean, that's no surprise looking at what the returns have done. The concerning part, though, is now if you dig even further to the next level, look at the Mag 7, they're in taking out Tesla, because Tesla is kind of the elephant in the room, that their price earning ratio has always been just way out of line.
Okay.
We're looking at the other 6, they're ranging from, on the low end, low end is Google at 23, to the high end, Amazon's at 40.
Wow, 40 times.
40 times,
yeah.
Right. Nvidia is at 32. So in Nvidia is kind of, to me, the interesting story in that. So they're at 32. Mm-hmm. And if you think, I mean, their earnings have just gone ballistic, as this whole demand for AI has happened. So for them to maintain 32 with that kind of an increase in earnings, that's why we've seen the rocket ship that we've seen with Nvidia price, is that the earnings are continuing to go up, and it's just continuing to drive price.
So let me ask you a question, because if the earnings growth slows, the PE goes higher, right?
If price stays the same. And that is in and of itself the significant challenge and concern that we face, right? Okay. I mean, just in and of itself, where we're at today at good earnings, it's overvalued.
Gotcha. Okay.
The whole broad market non-tech is at 20. Tech itself is at 26. Nvidia is at 32. Right. So it's already, 50% or more than the broad market.
Yeah.
With significant earnings growth. If something like this DeepSeek or other technology, and I mean, face it, they were kind of the first ones on the scene, right? I mean, it's in the first people on the scene, the first company on the scene, they get the benefit of that big push in the beginning.
Oh, sure. Look at Bitcoin. If you want to go with crypto, they're the name recognition, even though there's other things.
Right. But I mean, now that AI is becoming more, I don't want to say the norm, because it's still new, but it's becoming more commonplace, and other companies are realizing the potential there. They're starting to jump in. You're going to start to see more and more competition. And that's where, like Nvidia and these type of companies are going to face real challenge, because if they all of a sudden have their earnings start to drop because other competition comes in and their price stays the same, to your point, I mean, it could go 50, 60 times earnings. I mean, that is way, way out of line. Not
out of line. Yeah.
Which ultimately, I mean, at some point that has to correct. And meaning prices are going to drop dramatically.
So to kind of, I was gonna say, to kind of break this down just a little bit, Phil. So help me out here. So, if the Mag 7 are making about 24% of the S&P, right?
Right.
And you want to put some numbers on that. So you're saying, okay, if it's the estimation here based on some of this information is that roughly like $270 a share in 2025, right? So if you want to put dollars on there, that the Mag 7, just the tech, the heavy tech, right, would be about $63 of that 270. So if tech falls, if we have a big pullback and we're very overweighted, which is what I'm hearing you say,
right,
we could see a real. This almost feels like the housing bubble.
Yep. Yeah.
Am I right there?
I mean, this is kind of starting to look more like a tech bubble, which all bubbles at some point face a challenge.
Right? We don't seem to learn from the past, do we? Like every
we as human beings, I don't think learn from much.
I mean, it's been 17 years. I get since the housing, the big bubble, and but I mean, that to that point, we've been talking about this for a while now. That you have to give it back. Like we were talking about the fact that people were very happy that the market for the last 2 years done, it was 22%. The S&P was about 22%. And it was like, well, I didn't get all of that because I was being a little bit more conservative in my portfolio. That's probably a good thing because at some point it's going to give it back, right?
Correct. Yeah, I mean, so tech has had its heyday, so to speak, right? It's had the tailwind and it's driven the market with it.
Right. Not that it couldn't have another wind, but I mean, at some point you have to think, and it does feel very 2008, right? And that's scary.
Yeah, and I'm not saying jump out of tech, right?
No. I know that.
I'm just saying,
but it is bloated.
It's way bloated, right? Yeah. So I mean, especially if you're looking at this and saying, looking back at 24 and saying, wow, I mean, I missed the boat. I need to jump into tech, Nvidia. Let's put all, I'm going to put it all down on Nvidia.
We're going heavy. Yeah.
Put some brakes on, understand kind of where things are at. The headwinds, let's put it that way, that these companies, this whole tech with AI especially potentially faces. Mm-hmm. Not to say there can't be continued growth, but they're way out of line from the rest of the market. So the potential for a correction to bring it back in line is there. And tech always in and of its nature has had a higher growth, but looking at the NASDAQ, the Qs, right? I mean, that is what they do. They have a lot higher growth potential, a lot more volatility. But I mean, this is starting to get to some extremes that I think you've got to be very cautious going forward in the overweighting, towards that sector. And just go into it eyes wide open, right? It's think of it kind of like a roller coaster, right? I mean, the roller coaster of the S&P, that's pretty bumpy. Yeah. I don't know if I'm in Michigan, so Cedar Point, that's where we go. So, the Gemini back in my day, I'm an 80s baby. So that was kind of the roller coaster.
The Main Street, the all wooden one.
Yeah. Oh yeah. So those were kind of, some pretty good hills in it, but nothing like, I forget the name of the most recent one.
Oh yeah, that crazy one. I forget what his name is, but yeah, it's terrifying.
Anyways, it took my time, but yeah, I mean it has more than a 90% drop, inversion. So I mean you're talking about major drops.
Yeah,
so
it terrifies me just to look at it from the ground, let alone be on it.
I've ridden it. I like the thrills, but the bottom line, I mean that's tech, right? I mean if you want some major thrills and ride, just be in for it. Understand what you're in for. That is the potential there. And I think, like I said, the challenges potentially lie ahead, especially as this whole AI starts to broaden and we start to see more and more innovation and other companies come in.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
Okay, so I want to get one more thing in here before we wrap up this week. Try to keep it so we don't overload people, because I want to talk about the feds and tariffs just real fast. Let's do a deep dive next week, a deeper dive on tariffs, maybe try to explain that a little bit more to people. So the Fed, so what's the news there? Is the Fed, is it going to slow down things? Are we going to see growth slow? It doesn't seem to be.
Who knows? Right. I mean, the Fed did exactly what the market anticipated and paused. Okay. Which is good. I mean, we're starting to see inflation not decrease, right? I mean, it's starting in some segments has started to increase a little bit again. So we'll see. But that shouldn't be surprise to anyone, and it wasn't really to the market. That's what they hinted to at the last Fed meeting, is that, hey, this could be the last one, definitely not in January. They didn't say definitely, but they hinted very heavily towards not having a cut in January and kind of pausing. Where they
could be one later in the year, could be.
Yeah, one or two is kind of the hint that we got towards, middle to later part of the year. So we'll see. Okay. I mean, the bad part there is, unfortunately, we may be in this higher interest rate environment. I mean, we haven't, not terrible, not like we were back in the 80s, let's say, but it's nowhere near what their target is. So
I mean, it's obviously better than it was just a couple of years ago, but still, and obviously, I know President Trump is wanting to have them he's putting pressure on them to want to keep the rates low. So we'll
Correct.
see how that all plays out as well. So
Yep.
I think just from a market update standpoint, we're going to continue to see probably quite a bit of chop.
Oh, absolutely.
And so
Yeah,
being
there's-
balanced is really going to come into play.
Yeah, anytime there's change in markets, you're going to have volatility. Tech, there's going to be some changes, I think, going forward, volatility there, and just getting into a new administration, like we talked even in a prior podcast, right?
Yeah.
As some of these things roll out, tariffs, we'll talk about that in the next podcast, and some of the potential there. But
Okay. All
so
right.
just hold on, have a plan. At the end of the day, it comes down to having a plan. Don't panic. Don't be jumping out of the market.
Maybe don't chase and be too tech heavy. It sounds like, because it's.
But
a
just
little
just go into it eyes wide open. Be very cautious, especially if you're tech heavy.
Okay.
Just be prepared to either ride a lot of volatility out, or maybe trim that back a little bit. To take some of the profit off that you probably have received in 2024.
Right.
With the huge run up in tech.
Okay. Well, as always, folks, if you got some questions and concerns about how to handle things, and don't take any action or make any snap decisions just based on our podcast or any other, make sure that you're running the numbers with a qualified professional. Phil's been helping people for 30 years. He's got a lot of experience. He's a CPA and a personal financial specialist. So, again, sit down with a properly trained professional and make sure that you're talking about your unique situation. If you got those questions and you need some help, there's links in the show notes below. So just click on those and get in touch with Phil, or you can find them online. The number's been on the screen the entire time. You can give him a call at 248-888-7530 if you're listening to this in audio form, or of course you can find him online at philstaxhacks.com. And don't forget to subscribe to us on Apple, Spotify, and of course YouTube. And we appreciate all the growth here lately on the channel. So thank you so much. And we'll see you next time here on Phil's Tax Hacks and other retirement facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.